Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We're also going to jump in, take a look at transports as well as the semiconductors. We'll look at the U.S. dollar and some commodities. And today we're going to talk about the spike in inflation has actually turned the S&P 500 yield negative, meaning you are not making enough to cover inflation. What happens historically long term when the S&P 500 finally dips below? We're going to take an in-depth look at that. So let's jump right into the technical analysis here on the four major U.S. indexes. There's not a whole lot to say change-wise from last week. The S&P 500 is still holding up nice in that tight range, up near those all-time highs, continuing to make higher lows and higher highs for now. So that is certainly bullish. The Nasdaq, we're still watching that just over 14,000 level, but you can see here we have put in higher lows for the course of this year and some higher highs as well. So we're still trending up until either that 13,000 breaks or that 14,000 level break. So we're watching that pretty closely. The Russell still trading inside that range. It has gone essentially nowhere since the middle of February. A little move up, little move down, but it is just traded inside this range, and that's still what we're paying attention to, a sideways move after that huge push that we had at the end of the last year out of the mid and the small caps to digest those gains. Perfectly makes sense to us. We're going to follow this regardless of which direction it goes. Over 2360, we would be bullish on it. Underneath that 20,070 zone, we would become bearish on it. We're not going to make any guesses at this point in time. We're just going to watch and analyze what that chart does. We can be patient on it. The Dow is still holding up near those highs. You can see it held over that 33,500 level on this pullback right here. Been really strong, continues to grind higher. We're looking for a new all-time high, or if you're on the bearish side, we'd be looking for a break underneath that 33,500 level for maybe a back test to that 32,000 level for support. But right now, again, we're up near those all-time highs. It's hard to look at the indexes and be bearish. Let's take a look now at the transports. So here is the Dow Jones Transportation Index. And what we can see when we take a look is we are up near those highs. It has just been a solid push higher from that breakout at the beginning of the year. And we are now up in this nice, high, tight potential flag here in this uptrend. We're watching this for a move below 15,000 or a move above 16,000 for that next leg. Now, it is up near those all-time highs, and it is coming from down below, so you have a higher propensity for this to resolve to the upside. But again, we're going to wait to see which direction this goes. Now, when the transports are acting really strong, that's a really good sign. The other area of the market we really like to look at for that risk on behavior is the semiconductor index. Now, the semiconductor index reminds me a lot of the Russell. We had a big push at the end of last year, and then we've just traded in a sideways range. The semiconductor area of the market has not made a new high since March, and it hasn't really, broken below that 2,700 level. So it's really trapped between that 2,700 and that 3,300. I think where the semiconductors go is going to be very important for that growth area of the market into the second half of the year. So we're going to still continue to pay very, very close attention. A break over that 3,300 would be very bullish here for not just the semiconductors, but for risk appetite in the market. Let's now take a look in at the U.S. dollar. The U.S. dollar hitting back down towards those lows of the year. Made a little bit of a hold here the last couple of days, about 0.5% away from the low put in right at the beginning of the year. This is still not a very good looking chart. You have lower highs, and in the long run, you've had lower lows. And again, I'll always back this thing up and look at it on a monthly chart just to talk about how important this level is. All right, we are really, really paying very, very close attention to what goes on right here at this 90 level, all the way down to 88. Underneath 88, it gets very bearish for the U.S. dollar. But for right now, it's still hanging on by a thread, right? And we know when we take a look at our different commodities here, we've had some explosive moves. Now, we talked about the monthly close on copper being over 450 is important for that highest all-time monthly close. We've had a pretty strong pullback here over the last couple of weeks after this big push-up. You can see it's fighting right there on that zone. I want to pay attention to what happens here at the end of the month if we can close over that 450 or not. That is important. It's still up near those highs. It's still a strong-looking chart, but to not give us that highest monthly close would not be the strength that we'd like to see. Silver continues to hold up really well. You can see it is trading in that nice sideways range here for a while, but it is putting in higher lows in this range. We're looking for that move over 29. Gold continues to act pretty strong here over the last couple of weeks. After that big pullback here for a while, we put it at double bottom right there at that major 1650 support, and now we're back up near that 1900 level. We broke above it here for a little bit of the day on Wednesday, and now we've fallen right back to that 1900 zone. If we can hold right here and continue to push, I do think we see that 1960. That's going to be where that major test is. A move back above that would be extremely bullish. But that would be an area where I think you might be able to see some cooling off for the run that we've had here over the last month or so. Now we take a look at the other two metals I'd like to pay attention to. Platinum is still trapped between that 1150 and that 1300, which when we back this chart up again on a monthly time frame, we can see is right into that really, really important resistance level at 1300. A move above that would be very bullish. I think we'd get 1500. Still kind of chopping around, fighting in there. And Palladium is having a really hard time hanging up over that all-time high zone, which was right in there at about 2800. Broke above it, got to 3000. That's pulled back down. Really don't want to see that back underneath 26 and like 90 zone. That would probably target 2500, and that would not be very strong considering it took a year essentially to get to this point where it was making a breakout to those new highs right here, and then to not be able to hold on to it for any prolonged period of time is not what you want to see. We'll take a look at one more area that we really like to pay attention to in the commodity space, and that would be crude. You can see we're really fighting into that 65 to like 68 zone. I said this is going to be a major battleground. We've been fighting in it since February with no clear direction either up or down from this area. We're going to continue to watch. If we do break over that 68, I think we can run back up really towards that mid 76 zone. Again, if we look at this on a monthly time frame, if we can get up over that 78, there really isn't any resistance until we get back to that 100 level that we fell off a cliff from back in 2014. So this is a really interesting zone in on crude, not just on a daily chart, not just on a weekly chart, but also on that monthly long time frame chart as well. So we're going to continue to pay very close attention to what's going on over here. Now, when we take a look at the S&P 500, we are now not making anything after inflation from the yield off of the S&P 500. It's the first time that's really flipped below that zero spot since 2007, and really we've only seen it barely fall below that back right there at the dot-com bubble as well. 1987 we touched it, but really the only time that we've really spent any kind of prolonged time under it for more than a few years is back in the 70s and the early 80s. We had a couple of issues with that there. So this is not something that happens very often, and we actually have a record if you even include dividends in that. We include those dividends in there, you can see we are just about to break below that zero zone, and this does include back in the 1970s. So when we have negative real yields, that typically has spelt some trouble, and this is going to be one of the ugliest data sets that we've looked at in quite some time. The first time that the S&P 500 real earnings yield turns negative in 3 years, right? We have 1, 2, 3, 4, 5, and now a sixth signal right here. All right, so we only have 5 completed data sets. We can see that these numbers are really ugly. 6 months out, we've had some huge pullbacks, 30%. 1 year out, all of the negatives were over 20%. We get 2 years out, now we're starting to get a little bit more positive. Even 3 years out, we have some rough goes of things, and 3 years out to have barely positive numbers 3 years from this data set is not really what you want to see. So you can see, I mean, we look at a lot of different historical data points here. 3 months out, we were not positive any of the times in the past. So what happens up here is really, really important, given the data set that we have seen here in the past. And again, there's only 5 instances. We're printing money at an alarming rate, so the idea that this could be different certainly is always in play here with the way that we've changed the rules over the last decade, but this really is not a good look for us. And we can break this down by taking a look at the different sectors once this triggers, and you can see again 3 months later, that's historically what we're looking at is these big down draw across the board. But if we go out even again a year out, we see a lot of very negative components across the majority of the factors. The areas that did hold up well, let's look at it on a percentage basis. This is looking at how often it's positive after the signal, right? Again, you can see that 3 month we see hardly any positive numbers there. And we start getting a little bit more into the defensive stocks acting much better and value stocks acting much better 6 months out. They even look a little bit better when you go 9 months out compared to the other areas of the market. 2 years out, look at this as well. Value way outperforms growth. Now, that's kind of been a theme so far this year where the Nasdaq kind of stalled, and we have seen the Dow continuing to run. So this, data set gives credence to what we've seen so far this year that, that could stay in place for more than just 2 quarters. This could continue to go on for years, and historically when we've seen this kind of data set, that has happened. Now, I will give you one piece of positive data since we've just given a bunch of negative. The S&P 500 through the first 100 days of the year, like we are right now, has been up over 10% 20 times. And out of those 20 times that we've been up 10% through 100 days, 17 out of those 20 years have seen an average gain through the rest of the year of 8.6%. So the fact that we have been this strong this far into the year has historically bode very well for the rest of the year. Only 3 times that we've seen negative results out of the last 20 that's happened. So there is some positive here, but inflation, if we keep seeing that inflation run away here, it does start to become a problem when we look historically at the different data sets and what that can mean for us moving forward. As always, thank you guys for tuning in. Hopefully you found the information useful. If you guys want to reach out and talk to me directly, you can reach me at mtedeschi@perspectivewealthplanning.com or give me a call at 814-580-9881. I will see you guys next week. Take care.